All right, all right, all right. Thank you for joining. Thank you, everybody, for watching. And I believe that this is going to benefit so many people. Welcome to River Rock Financial Group's presentation of the Trifecta strategy. My name is Max Wiltz. The website is rrfgwealth.com. So River Rock Financial Group is a financial services company, a insurance company with the mission of, I'm going to paraphrase here, with the mission of teaching people, individuals, and corporations how to protect what's most important, develop strategies to increase financial accumulation and wealth building. So let me first cover myself. Every example here, all examples are for illustrative purposes only. No representation, not representative of any particular investment or an offer of insurance coverage or benefits. Values shown are before tax. All withdrawals from a retirement plan are taxable as ordinary income. Please consult your tax expert or advisor. Now that we got that out of the way. All right. So before I get started, let me talk about why insurance is important and what I can do, what River Rock can do for you. For centuries, individuals have understood the power of accumulation and developing and generating enormous wealth streams and protecting their families all at the same time using insurance. So insurance and time and building wealth are all related. So basically, life insurance is not for death, it's for life. I'm going to repeat this again, but it's the continuation of life that's important. The continuation of a standard of living, the continuation of generational wealth, or somebody has to start it for it to continue. We've all heard of the mega wealthy families on this planet, in this world, and most, if not all, use insurance as a way to do several things. One being a hedge against inflation, and to create accumulation and to create an asset. Insurance becomes an asset in several different ways. All right. I don't know what this is, but let's move along. All right. So let me read the script. Building wealth over time. Historically, used to efficiently increase and pass down wealth simultaneously at the same time avoiding certain tax mechanisms. The rich and wealthy have been using insurance for centuries, and so can you. So let's move on. All right. So what are the 6 excuses, or I have 6 of the most common excuses to why people don't have insurance? It's an excuse. There is a way to acquire some form of insurance coverage, whatever product it may be, and then utilize that product to benefit you and your family and your business now and then in the future. One, a bullet point number 1, they think it's too expensive. 2, it makes them think of death. I can't tell you how many times I've heard people say, don't talk to me about life insurance, because it makes me think about death. We insure everything else. We insure cars, boats, pets. I may do a presentation on just insuring pets. Buildings, we insure everything. I've seen people insure all types of stuff. But when it comes to life insurance, for some reason, the human being in certain demographics, yeah, I said it, don't see the value. But that's what I'm here for, to teach the value. Employer policies. A lot of people say, I have insurance through my job. Well, your job insurance, it has some limitations to you, not to the employer. Some people think their health is too good or too bad, or it's not good enough, or it's too good. I'm young, I don't need life insurance, or I have bad health, so I can't get life insurance. And I say life insurance is a broad spectrum because there are several different types of insurance products. Lack of knowledge. Some people just don't know. They don't understand. or they don't want to understand because they've been told by somebody else, oh, it's just a scam, it's just a ripoff, which is totally untrue. Or lack of trust in carriers, family, and agents. People don't trust their family, the insurance carriers, or the agents. So let's dive into how to get rid of these excuses. The too expensive excuse. Life insurance is too expensive not to have. My mother passed away in 2015. I was part owner in a company, and so I did not have the funds to take care of her final arrangements. So I had to use my personal income plus some income from the business that I partly owned. I had no insurance. Had that been I would have been able to, had that been the case, had I had an insurance policy on her or her having an insurance policy, I would have been able to take care of the expenses without going into my own funds. A lot of people say this is the number one, probably the number one excuse. And then what they do is when time comes, they're not prepared. And they're having to do fish fries, they're having to raise a GoFundMe page, they're having to go to the church, they're having to go to all these different sources when they could have just planned ahead. Planning ahead is less expensive than planning in the moment. At least have a term policy because that is a low cost policy. Term policies, which I'm going to talk about here today, term policies have lower premiums for set amounts of time. 10, usually 10, 15, 20, 10, 15, 20, or 30 years. And you can convert part of term policies when the term runs out. There's several carriers that will allow you to convert the term or part of it in the future. So there's really no excuse. Many carriers have highly flexible plans, flexible premiums, paid up insurance. I mean, it's all types of ways. There are riders that you can add to the policy to pay the policy if something happens. There's accelerated benefits. There are all types of ways to have life insurance that will benefit you now and when the time comes to take care of the final arrangements. It's really bothering me. The benefits of having insurance far outweigh the cost of getting insurance, life insurance today. So the too expensive excuse is out the window. All right. Thoughts of death. The truth and fact of life is that we're all going to pass away. We're all going to die. We are all going to transition at some point. I don't know why. Well, I do know why. People have to need to start getting used to the fact of life. This is part of the cycle. Okay. Instead of thinking about death, think about your family and the legacy you're going to leave. However, there are insurance policy types that are about life. All of them are really about life. Because when you go to a service, right? You go to a service for a person that's passed on. The life has to continue. So one of the ways to continue life is to make sure those things are taken care of, just like you take care of your bills, just like you pay car insurance so you can keep driving the car. So like if a house burns down, they can rebuild the house or give you a check to rebuild the house. If something breaks, insurance is, I don't know if I can stress this enough. It is a part of life. Okay, life insurance, not death, is meant to move life forward. It's meant to move life forward, not pull it back. Okay. All right. Employer policies are not portable most of the time, or they are if you want to carry the expense. And trust me when I say insurance, employer policies are expensive. Most of them don't have auxiliary features. For example, you get an employer policy, you make $100,000 a year, or $50,000 a year, or whatever, and you get the life insurance policy, and they say, okay, how much coverage do you want? And you say it says one, two, or three times your salary, and that's it. Usually, if I'm wrong, please somebody tell me something different. But usually, what happens is you go in, you pick how much coverage you want. I know somebody made $75,000. All they can do is 3 times 75, which is 150, if I'm not mistaken. Is that right? I don't know. No, that's not right. It's like almost 200,000, I think. All right, so 225, something like that. I don't want to do the math right now, but They don't have accelerated benefits. Like if you have your own life insurance policy, you can actually access part of the face value in the case of a chronic terminal or illness. Accelerate the benefit. You can access if your policy. I'm going to talk about that in a second. All right. You cannot control your values with employer policies. All right. Your health is good or bad. Of course, when you're younger and you're in good health, policy premiums are lower. Challenged health is not a barrier. There are several life insurance products that allow you to obtain coverage now. I mean, there are so many ways that insurance carriers want to give people life insurance, right? As an agent, I've seen a lot of carriers come up with different ways to make sure people can get coverage. I'm not going to go into grave detail. And then annuities, which we're not talking about here today, which I am, but it's a little bit. Annuities are a great way to have some type of coverage because they do not require a medical exam. And then lack of knowledge. The confusion is not asking questions. If you don't know, ask. In today's world, there's a plethora of information. We're living in a time of human history where information is prevalent. You can access information sometimes about things you don't want to know, but this is one thing you want to know. You want to know about the questions you have about insurance. Well, how much coverage can you get? What if I have this? What if I take this medicine? What if I'm going out in the country? What if I've been working on this type of job? What if I want $1 million policy on my spouse? What if can I do blended insurance? It's all types of ways. So the lack of knowledge argument is out the window. Okay, and then life insurance is really a straightforward process. It's not a mystical thing. You want coverage. Here's a product. I'm going to ask you some questions. You may or may not have to do a medical exam or what they call a paramedical exam, just a few specimens, and then it's over. Then they make a decision. Most carriers do instant decisions, or sometimes they don't do an instant decision. It takes a couple of days or maybe a few weeks, maybe, depending on what information you provided. All right, and then the lack of trust of carriers and agents. I thought I put a family in here too, but some people don't trust their family. Uh, you see the movies where somebody's trying to uh, do something to somebody because they know they're gonna get insurance money. I mean, yeah, let's not talk about that. Family members are going to benefit, especially your children, right? Your children are going to benefit from life insurance. Uh, uh, all agents, brokers, and carriers they are trying to achieve high standards. Every carrier I represent has an A rating with several different agencies, Better Business Bureau, the list goes on and on. A rating, AAA, all of them have A's. All right, and it is designed to benefit the owner of the policy and the beneficiaries or business continuity. A lot of businesses take out insurance policies on key people. The key people take out the policies on themselves. So I don't, I do get it. I understand. It's a highly regulated industry. This is not something like real estate investing where I don't have to have a license and I can start investing. It's not like that. Not that that's a bad industry. It's a great industry too. Insurance is very regulated. There are a lot of things that are being watched when you talk about insurance agencies, carriers, brokers, etc. All right, so what's the let's get to what the trifecta is. So of course, trifecta means three, right? And what we're doing here, and what I've done, and what the agency has done, is create a strategy in which you can combine three types of policies, three types of products for a reasonable cost. Now, to provide for you right now and your family in the future and a death benefit, all three rolled into one. And what you do is you do it at one time. You don't wait and say, "Oh, I'm going to get a term policy. Oh, let me go get a whole life policy. Let me go get an annuity." No, you do all three at one time. That way, you take care of all three. It's done, and it just keeps going. You talk about accumulating interest with the whole life policy, having a higher face amount and a lower premium with the term policy, and then having a small annuity. Now, some people want to go, they're a little bit more aggressive, so they want to have a higher annuity. All right, we're going to talk about that in a second. So let's look at what it does. A, you have the cash accumulation. All right, life insurance really especially whole life policies are assets. And I see people pay off, use them to do all the different types of things. So the whole life policy, the cash accumulation, the term life, high face amount, low premium, and then the annuity is the guaranteed interest rate in the future stream of income. So not only are you accumulating cash in your whole life policy, you have, and that has a death benefit, a face amount, which by the way you can access through accelerated benefits. The term life policy has a high face amount, which is combined with the whole life policy. So those two work together. And then you have the annuity, which you set and leave alone, and then it's going to guarantee you interest over and over and over again. And then when you want to access that future stream of income, you can. And on top of that, at the end, you have a death benefit to pass down to your beneficiaries, so they can take care of they can take care of A, your final arrangements, and B, they can have income and a stream of income and wealth. So I hope this is getting across. All right. And they all have favorable tax advantages. The annuity is growing your money tax-free. You're hedging against inflation. So the whole life policy and the annuity are gaining interest. Well, the whole life, not so much the annuity. The annuity is gaining interest over time. Leave it alone. So here's what it looks like. It's like a house. You're building a house. Whole life, annuity, term. So whole life is a foundation. Annuities in the middle, and the term is like the icing on the cake, because what it's doing is it's increasing the face value of your policies. I'm going to show some examples here in a second. So example number one, which I'm going to actually show you a real life illustration or illustrations. Just bear with me. All right, so here we have illustration number one, example number one, a $50,000 whole life policy, a $100,000 term life policy or face value, and a $50 a month deferred annuity. Okay, then example number two, you have so I basically flipped it around. $100,000 whole life, $50,000 term, which combined $150,000 face value, and a $50 a month deferred annuity. Okay. Now I do have an annuity presentation, which you can go back on YouTube and watch, to show how annuities gain interest over time and the beauty of the annuity. Okay. Example number three, $50,000 whole life, $50,000 term, and $100 a month deferred annuity. So what we've done here is increase the annuity premium to $100 a month. And again, that's deferred. It's flexible deferred. And then example number four, a $50,000 whole life, $100,000 term, and $100,000 deferred annuity. So just to recap on the trifecta examples before I actually show you some illustrations, combined $150,000 face value and the $50 a month deferred annuity. Okay. Example two, still combined $150,000 face value and the $50,000 $50,000. Some people do $50,000 annuities, by the way. But anyway, $50 a month deferred annuity. Okay. And then example three, you have a combined $100,000 whole and term, and then $100 a month deferred annuity. And then example four, $150,000 combined with a $100 a month deferred annuity. Right. So I know this may be a lot, but what I'm going to do is show some actual examples now. Okay. All right. So number one. So what we have here is I did have number five. Okay. So this is actually supposed to be number five. So it's combined $200,000 face value with a $10,000 one-time premium, multi-year guaranteed annuity. And I'm going to show that at the end here. Okay. What this means is You have $200,000 in face value with accelerated benefits. What that means, while you're living, if you experience a diagnosed illness that dictates you're able to access some of the 100,000 or the 200,000, then you can submit a claim, and usually you can access half of the uh, face value. So you'll be able to access $50,000, at least $50,000 in face value, which would decrease your face value. So let's say, for example, you accessed $50,000 of the whole life policy, then the face value would then be reduced to $50,000. Okay, but you still have the $10,000 one-time multi-year guaranteed annuity, which means you put $10,000 in one time, you roll it over, or you just had $10,000 laying around not doing anything. You put it in one time, and they guarantee you interest for 3, 5, or 10 years. I usually recommend the 10-year mark because it gives your money, that $10,000 keeps growing at a guaranteed interest rate for on top of the 10,000 for 10 years. And interest rates change all the time. Sometimes they're 5, sometimes it's 7, sometimes it's 4. It just depends on the carrier. Okay. All right, so let's look at example number 1. Back to example number 1. All right, so you've got a female, 29 years old. She chose to get a whole life policy at $50,000 a month. Okay, it's $84.71 a month, which isn't bad. Okay, all right, so remember that $50,000 face value at $84.71 a month. All right, and here is, you look here closely, it automatically has an accelerated death benefit for terminal illness. What that means is, right here, I'm not going to read the whole thing. Right here, it says that once they receive written proof required on the proposed insured that this person has a terminal illness, they may access part of the $50,000. Boom. Now, as you see here, attached to this is a $50 a month annuity. As you see right here, in no case will the minimum guaranteed credited interest rate exceed 3%. So you get 3% on your money. No, it doesn't seem like a lot, but I'm going to show you some examples here. And you actually get a guarantee of actually no less than 1%. All right, so here's that same person. As you can see, you look at the cash value column. You see her cash value is growing, which, by the way, you can access the cash value. All right. My computer has a mind of its own. All right. And then, so we're not going to deal with reduced paid up insurance right now. We're only going to stick with cash value. Reduced paid up insurance is a great thing as well. I may do another presentation on reduced paid up insurance, but I don't want to add any more information to this particular presentation. All right. So I know it can be a little bit, a lot. All right. Now, along with that, this same person, 49 years old, they want $100,000 term policy. And as you see, this is called, it's 30-year term. It's a 30-year term. So for 30 years, guaranteed level premium is not going to change. $23 a month. $23 a month, $100,000. And she can still access, she can access part of that $100,000 for terminal illness. I mean, what is a no-brainer? I don't understand. So here you go. Number 1, example number 1. For $158 a month, total benefits with a higher term, $150,000 face value, accelerated benefits. The term can be partially converted if after 30 years, if they want to. The annuity builds income, an income stream. She's 29. Given everything being great, or life in general, and she's gonna live a long time. She's gonna live to 100. And it's a flexible premium annuity, so therefore she can increase the annuity premiums if she likes. This makes sense. Number 2, here we go. Female 39. $100,000 of, as you see right here, it says whole life level pay at $145 a month. Okay. And attached to that is the same deal, the same $50 a month annuity. Here is her whole life policy at $100 a month. Of course, in year 1 and 2, there's no cash value. But as you see, the cash value starts to build, which, by the way, you can access. You get the whole life policy is not like the annuity. As the cash value accumulates, you can actually borrow from yourself. You become the bank. And then her $50,000 term policy is only $21.58. So what does that tell us? At $217 a month and 54 cents, that's not right. $217.54, $150 face value. She has a higher whole life policy. And the same deal with the annuity. Okay. So number 3, a male, 44, whole life, $100,000. As we get older, insurance premiums go up. $135.98 a month. That's not bad. Okay. I see some commercials on TV for one particular carrier. And I don't know, I'm not gonna call their name, but they said some things. It's what some carriers do is they don't they omit some stuff. So this is in your face. It's not, it's $135 a month, 98 cents. Okay. Which is good. As you see, cash values accumulating, $100 a month. $135.98 a month on the whole life. He wanted $100,000 term, which is $55.25. So he got combined $200,000 in face value, which again, he can access part of those face values if there's a documented medically prescribed terminal illness. You can access part of that 200,000. And then here is just to give you an example of at 30, this thing is going to run till he's 73. The carrier is going to allow you the option. I've seen some carriers allow people the option to convert part of the term policy to whole. You don't have to convert all of it. All right. You can convert part of it. All right. I know some carriers that do that. I've seen it happen. I've tried to I tried to get a client from one large carrier, and they immediately told her, "Oh, well, we'll convert part of the $250,000." Right. On the phone. They didn't want me to take her from them, which is good business. All right. So here's an example of a single premium, the annuity we're talking about that's attached to those two policies. Here's an example. Okay. So here's the single premium, $10,000. Here's what happens if you do a single premium. Now, again, I'm going to say this again. I did a presentation on annuities. You can go to my YouTube channel at River Rock Financial Group LLC. You can just type in River Rock Financial Group, and then you can see what actually happens on a $100 a month annuity. Here we're looking at the single premium multi-year guaranteed annuity for that 44-year-old male, and he decided to roll over $10,000 into a single premium. No more premiums are needed. Again, insurance carriers have a lot of creative ways to provide people coverage. So here's what happened. I'm going to break this down. Okay. So remember, we have the two policies in play, right? In force. The initial guarantee rate of 4.55%, guaranteed for 5 years. And then after that, the minimum guarantee interest rate is 2.9%. Banks' interest rates, a lot of interest rates fluctuate. They use different markets to base their interest they're giving you on your money. Okay. On top of that, this particular provider, highlighted here, I'm sorry, this particular carrier has a member emergency access rider. After the first certificate year, a one-time emergency access withdrawal may be taken from the account value without a surrender charge or market value adjustment. Okay. Now, this is a 5-year guarantee interest. Watch what happens. All right. So he rolls over wherever he gets the 10,000 from, 401k, savings, whatever. You won the lottery, who knows? All right, so at 4.5% in 10 years, that thing's gonna get to $14,446, and he hasn't done anything. Left it alone. There's minimum guaranteed. Because at 5 years, it's 4.5. At 6 to 10 years, it's guaranteed 2.9%. Now, we I don't know what bank interest rates are on savings accounts right now, but I can pretty much assure you that uh, they're not getting close. I would go check, but I've seen banks do some real interesting things with interest rates. So at cash surrender value before market value adjustment at year 10, leave it alone at year 10, don't touch it. At year 11, look what happens to this thing. There's no penalty, no market value adjustment. Now, to me, it's one of the best things going. Okay, annuities have been around for a long time. It's a way for you to get into investing with low risk. Okay. All right. Look what happens at year 20 with this one time $10,000. So he's 64 years old. He wants to go on a trip, or he's got income from somewhere else, and he just let it sit there. At year 30 is at $25,000. He hasn't done anything. A lot of people, me included, have started investment, mutual funds, whatever, and I've made a mistake pulling cash out. Sorry, Mr. Bolden. Okay. All right. Anyway, so you see what happens here. Okay. All right. Uh, now, let me go back to number 3. So here's what happens with that particular example. All right. The total monthly premium is $191.23, $191.23. Okay. For a face value of 200,000. But here's the beauty. That $10,000 that he rolled into an annuity, he doesn't have to pay a monthly premium on that. He's 44. His income's going to go up $213. He budgeted for that 10 years ago, and it just keeps rolling. I'm sorry, that $191.23, he budgeted for that 10 years ago, 20 years ago. Matter of fact, at year 20, when he's 64, he just take the whole thing out or roll it into another. I mean, it's just so many ways to be creative with this. I think education is the key. Okay. That's the beauty. The one time, and sometimes the one time lump sum single premiums can be as low as $5,000. Okay. Some of them you can do. I've seen carriers do. You can put up to $1 million in an annuity. So imagine what I said at the beginning of the presentation. Imagine what's happening when rich and wealthy people take $1 million and put it into an annuity that's gaining at least 5% interest. And what we do is get upset. What a lot of people do is get upset when rich and wealthy people continue to get richer and richer. It's not because they're doing anything special. It's because they have the information and knowledge. Knowledge is the key. So as I conclude, here are 4 simple questions. Do you know what's going to happen in 10, 15, 20, or 30 years? No, you do not. I don't care how much AI we have. I don't care how many models we predict, or I'm sorry, how many models we build, how many degrees you have. You have no idea what's going to happen. Nobody does. So we can crystal ball. You can go to you can go get your stars read. You can do everything you want to, but 10, 15, 20, 30 years, nobody knows. Okay. Can you afford to not act now and place you and your family in a better position? Like I said at the beginning in the beginning of the presentation, life insurance is about life. It's about future planning. Do what's difficult while it's easy now. Don't try to do what's difficult when it's difficult. Do what's hard while it's easy, and things will be better. A lot of times people try to do it in reverse. Something happens and they get blindsided, and now we're scrambling trying to. I'm a great example. My mother got sick. There was no way to get insurance on her at that point, so I had to. And really, we were trying to take care of her. We were taking care of her, and when the time came, I then still had to try to find, and I did, the funds, thank God, to take care of her final arrangements. How will you outpace inflation? So unless you're a multi-millionaire, and sometimes they even have trouble, and you want to build to millions, you want to get, I know a lot of people have told me, well, I don't want my kids getting rich off of me. Bad attitude. It's not about your children or your beneficiaries getting rich. It's about, first of all, telling them, I'm going to do a presentation on this, telling your beneficiaries what's going to happen. Then making them have a plan or developing a plan to continue the accumulation of whatever you leave them. That's the key. That's what the majority of people don't do. We are so caught up in surviving, being entertained, comfort, that we don't plan. And when it comes time, what we do is we panic. That's going to be a good presentation, by the way. All right. So, how are you going to outpace inflation? And for your kids' inflation, your kids, so on and so forth, your family, whoever your charitable organization, your university, whoever your business, who are you trying to protect? And then, do you believe in delayed gratification? One of the beauties of annuities and other products like the Index Universal Life Policy is that that's a delayed gratification strategy. The old saying, I became an overnight success, but after 5 years or 10 years, it looks instantaneous, but it's not. Amazon looks like it was instantaneous, but go read the story. It wasn't overnight. A lot of people look at things, especially in today's world, we want to tap the screen or click the button. And it really took a long time for that. It took a long time for your phone to be able to tap that button and get something done, or just get a Uber ride or pay for it on with digital currency. And then what will your family do when? When. Not if, but when. Okay. All right. So hopefully you enjoyed the presentation. Here are some of the carriers we represent. I'm not going to go through all of them, but I did highlight Royal Neighbors of America Life Insurance and Annuities today in this particular presentation. Here are all the other ones that we represent. So understand that these are very reputable organizations, and I would be remiss if I did not mention them. All right, so are you ready to get started? And hopefully, if you have any questions, you can reach out to me at any one of my uh, social media outlets, platforms at River Rock Financial Group, LLC. You can also access the website at rrfgwealth.com, rrfgwealth.com. Here are my direct numbers and my office number. We're available. Please, if I don't get in contact, if I don't reach back out or answer, please leave a message or email or DM on Instagram, Facebook, or YouTube. And until next time, guys, don't wait. Do what's easy while it's difficult. Thank you.